Hello, I am Vince Pizzano,
And I'm Kaylee Blaylock.
and this is our data analysis final project.
So to start us off here this evening, we created this pie chart to kind of show our investor all of the different properties that we will be analyzing to compare to their specific investment property that we will talk about in the nitty-gritty a little bit later on in the presentation. It's one thing that we've learned throughout this entire class and over the course of our degrees is that real estate is all about location, location, location. So we wanted to showcase what three locations and what percentage of these locations was being displayed in our data set for our investor and for our own knowledge base. And here is a statistical analysis chart. Again, it is important to note that these numbers and these calculations are all done for the entirety of our data set. So this includes Roanoke, Salem, and Benton properties, not just our specific investment property. We are looking at the mean, median, min, max, and standard deviation of the sample size for the list price, sold price, days on market, gross building square foot, acres, annual taxes, gross income, and NOI for all of these subject properties.
Moving on to the ANOVA analysis, we looked at a couple different variables. And basically the point of an ANOVA table is to see whether the specific variable has an impact on the sold price of the property. So looking at the city variable, the F ratio is less than the F critical, which means we fail to reject the null hypothesis. In simpler terms, the city variable does not have an impact on the sold price of the property. The second ANOVA analysis we looked at was the parking description variable. In this ANOVA table, you see that the F ratio is greater than the F critical, which means we reject the null hypothesis. Again, in simpler terms, the parking description does have an impact on the sold price of the property.
Now we are looking at two regression analysis run. The first has a dependent variable of sold price, and the one on the bottom, or the second regression run, has a dependent variable of the closed list price. And you can see just how changing just one variable, we kept all of the other independent variables the same, can change throughout both regression analysis. In the top one, your reference category, which is the category chosen by Excel to be your reference category, is the municipality of Salem. And then in the second one, the municipality was changed to Benton, was the second reference category that you can see here, and just how this will impact our subject property we'll cover in a little bit later. So here is our subject property. We chose a duplex in Salem, Virginia, sold for just under $300,000 at a little over 3,000 gross building square foot. It's 13 years old on 0.27 acres with a gross income of $29,100 and an NOI of almost $24,000 a year. So looking at the chart below, it is important to note that we made an assumption of inflation for about 3%. So you'll be able to see that throughout the chart there. That is just an assumption that we made to include inflation in our results to have the most accurate decision analysis chart that we possibly could. Our debt service coverage ratio is looking really, really well and continues to get even stronger all the way up into year 10. We are really pleased with that. As well as you can see our capital return, gross profit multiple, levered cash on cash, and cash on cash as included in the IRR of 38%, which we are also very pleased with. And here is, we thought it would be important to include an amortization chart. Another assumption that we made is that there will be 20% equity down. This was concluded just by looking at past assignments and industry averages of about 20% down on these types of investment properties. So that brings our loan amount down a little bit. An assumption that we also made with a length of 20 years with a 6% interest rate. Both of those were assumptions, again, just based on industry average and our personal knowledge that we've accumulated over the course of our degrees. And you can see here through all the way through year 10, you can see the ending balance and then each one of those payments. Again, this is an annual payment. In the chart above, you can see the monthly payment is just above $1,700 a month, but that equates to about $20,530.08 as an annual payment. And then you can also see the interest rates going down based on how many payments that you go. That's expected to see in an amortization chart, as well as the principal amount that you pay every single month to increase.
We learned from our statistical analysis that the average NOI for a multifamily property in the Roanoke area is roughly $17,000, which is about 30% less than the NOI of our subject property, which, as you can see in the chart, is about $24,000. Now, as Kaylee mentioned earlier, with the assumption of a 3% inflation increase, the estimated NOI by year 10 is $31,000, which is a 24% increase from year one, which obviously means for a good investment. To conclude our presentation, we would recommend purchasing the multifamily property at the seller's price of $298,500. The debt service coverage is fair based on the chart that we reviewed in class, but it does grow with time. The high IRR of 38% is definitely promising for investors as well. And as I mentioned before, the average NOI for this specific property is 30% higher than any other multifamily property in the area. Further research showed us that this property today is estimated to be worth north of $330,000, which is a 10% increase in the selling price of the property. Again, another signal to definitely invest in this property.